I was reading on Twitter the other day and I started analyzing how 2026 could play out, and something very interesting came to my mind. Everyone thinks that 2026 is going to be a straight line bull market. Stocks up, crypto up, new all time highs across the whole board. But that narrative might actually be delayed. Because if you zoom out and connect the political incentives, the Fed timeline, and the election calendar, a very different picture starts to form. So here is my theory how 2026 could actually look like. And if this plays out, the next few months may be way more painful than most people expect. So let's go first through the setup, the fragile economy. Let's start where we are right now. The US economy isn't breaking, but it's definitely bending. Layoffs are quietly rising. Corporate bankruptcies are ticking higher. Credit card and auto loan delinquencies are building. Housing demand is falling off a cliff, and sellers are outnumbering buyers in many markets. Even the core retail spending, which is the biggest driver of the US, fell with 0.1% in December, the weakest reading in 3 months. So, spending declined across clothing, furniture, electronics. I just want to tell you that the statistics shows that spending declined. Lower income households are cutting back the most as budget tighten and essentials take a bigger share of the spending. Wage growth slowed to around 0.7% in Q4, the weakest pace since 2021. Since the retail data feeds straight into GDP, the drop signals weakening consumer demand and slower economic growth. This is not the backdrop of a strong expansion, it's the kind of environment where something snaps. Because when liquidity tightens and growth slows at the same time, markets don't just grind sideways forever. They correct. And that's why there is a real chance of a market pullback in the next 2 to 3 months, similar to what we saw in early 2025. And this is what I made a members only video here talking about the technical background, the technical analysis of the chart. And I reached to the same conclusion that in 2026 we could go much lower by another 20%. You can watch that video by joining Saratoshi squad. So the downside could look something like this: the S&P 500 down 10 to 15%, Nasdaq down 15 to 20%, and crypto doesn't just politely correct, it overreacts. So if stocks sell off, crypto will likely see deeper drawdowns, forced liquidations, and possibly a full capitulation phase. And this is the part where optimism dies and everyone starts asking the same question: what went wrong this time? Now, the second narrative here is the blame. And to bring the Fed Chair Powell in the picture, this is where politics come in. During a market downturn, someone always gets blamed. And in this scenario, that someone is likely going to be Powell. His term ends in May 2026, and the timing matters a lot here, so I want you to focus very well. If markets weaken heading into early 2026, the narrative practically writes itself right now. The Fed kept policy too tight, rates stayed high for too long, liquidity wasn't injected when markets were fragile. Trump has already shown he's more than willing to publicly attack the Fed. We've seen that a few times. And if the Supreme Court rules against his tariff policies, that's a second target, one more target. The goal here wouldn't be just messaging, wouldn't be just blaming, it would be positioning. Because even after Powell's term as chair ends, he could remain one of the board of governors and still influence policy. If Trump wants a fully aligned Fed, Powell has to go completely. So the theory what I'm trying to reach is simple. Let the pain happen. Frame Powell as the obstacle. Make him the villain, the bad person. By the time Powell exits, the public already has somebody to blame, according to this narrative. Then, I want to bring something else to the picture, the pivot, where liquidity starts returning. This is the flip part. Once Powell is out, a new Fed chair steps in. That's most likely Kevin Warsh. And the tone changes fast here. Warsh has previously signaled openness to aggressive tools, including the yield curve control. And that is a big deal. Yield curve control means the Fed steps in to cap long-term bond yields. Lower yields mean cheaper borrowing. Cheaper borrowing means more liquidity. More liquidity means higher asset prices. That's not theory, that's how modern markets work. And this easing wouldn't happen in isolation, of course. Other liquidity drivers could line up at the same time: potential tariff, dividend checks, large scale tax cuts, pro crypto regulations like the clarity around market structure laws. Each one on its own is stimulation. Each one on its own is stimulative. Together, that's forming a rocket fuel. Stocks benefit, crypto benefits even more, risk assets rip higher. This is where sentiment flips from despair to disbelief. So now, let's talk about the timing, the midterm election incentive. Now we zoom out one more step. US midterm elections land in Q4 of 2026. Right now, betting markets are signaling trouble for Republicans. And nothing changes voter psychology, our psychology as voters, faster than rising asset prices and extra cash. That's the thing that could influence our psychology the most. If markets are crashing in early 2026, voters are angry. If markets are ripping in late 2026, Q4 of 2026, where the elections happen, voters forget what happened in early 2026. That's just reality. A strong market heading into elections creates positive headlines, higher retirement account balances, stronger small business earnings from tax cuts, and the feeling that things are improving. And importantly, the blame has already been assigned. Powell becomes the symbol of everything that went wrong before the recovery. The new Fed gets credit for the turnaround. And this is what I think we would see in 2026. Now, I talked about the late 2026 and the early 2026. Let's put all of this together and see how the whole year would pan out, what the timeline looks like. So what I think, early 2026, we would see market correction, fear returns, or actually we've been in fear now for the past 3 months. I would say fear stays. Powell takes the blame. In mid-2026, as we move along, we have the new Fed leadership, policy pivots, liquidity starts ramping up slowly. Then late 2026, markets recover, risk assets surge, optimism returns just in time for elections. This doesn't mean prices only go up from here. It means the road there might be brutal. And for investors like us, this matters a lot because the worst time is to sell emotionally. And that is often right before accumulation quietly begins. So if the strategy plays out, the start of 2026 could be quite painful for all of us. But I don't want you to give up because the end of this year would bring the recovery and new highs. Again, this isn't guaranteed. Markets are messy, politics are so messy, nothing plays out perfectly here. But incentives matter. And when you align economic stress, Fed leadership changes, and election timing, this theory becomes very hard to ignore. It might not be fully true, but if you can see the logic in it. So the next few months could shake people out completely. The middle of 2026 could feel boring and uncertain. And then, when most people least expect it, we'll see liquidity returning. History doesn't repeat exactly, but it rhymes. And if this rhyme plays out, 2026 won't start with a pump, it will start with a pain. And the middle would be very boring, but the end would be beautiful. That's for me today. Thank you so much for watching. I'll see you in the next video.